It's big news. India has been included in one of the global bond indices. Now, those are big words, but to make it simple, Indian bonds can be bought and sold abroad. So it's a big deal.
Thank you, Rishad. So it is a momentous day, actually, if you might allow me to say that, for the Indian bond market.
The big news we got late on Friday was with regard to India getting included in the emerging market bond. Big news, right?
That was big news, really. And, all the experts told us that will mean inflows into the Indian bond markets in a big way.
But the big, the development, the big headline is that India is going to get added to the JP Morgan Global Bond Index.
But what does it mean? First of all, for the government, for the economy, and for you and me. Also, remember, this has happened without India having to offer a preferential tax treatment for those who are coming in to invest in Government of India bonds from abroad. To discuss all of those and to explain this thing on this edition of On Point. Let me state the news again. JP Morgan has decided to include India government bonds in its government bond index for emerging markets with effect from June 2024. To provide a perspective, the highest ever net foreign inflow into Indian bonds was about 26 billion, and that was in 2014, about 10 years ago. This year, till September calendar year, it is about $3.5 billion. So when this announcement comes, and when I say it's a big deal, what are the numbers we are looking at? Well, the numbers are that if just with this bond inclusion, India can look at a positive of at least 20 to 30 billion dollars. If the others like FTSE Russell and Bloomberg's index also comes into the fray, those numbers will become even larger. So it's a very big deal for entry of foreign money into India. And remember, there's a 30-year history to it, and that is a big step in that context. And I can take a bit of credit because I was one of the first news reporters talking about this possibility as early as the year 2019, as this news report shows. But let's get away from there. Let's just, before we get into those billions of dollars, let's try to understand what this all means. Let's get some primer first. How does one raise money from a market? There are two ways. You could either sell shares, which means that if you're a company, you are telling investors that come and invest in my company and I will give you a part of the profit. Or you could raise debt. When you raise debt, you give the holder the assurance of a confirmed interest rate, and in return you basically the investor buys a bond from you. So for corporate debt, it's called a debt paper. For government papers, the usual nomenclature is bond. There's not much to differentiate there. These are simply names that are used. Now, say there's a company like Life Insurance Corporation. Even though it's owned by the government, it can sell shares. In fact, it has sold shares. HDFC Bank, it's not a government company. It sells shares. Those shares are available in the market. Similarly, abroad, a Microsoft, a Google, all of them sell shares. But a government of any country cannot sell shares. After all, a government is not an entity for making profit. But the government can and does definitely raise money through the medium of debt. All major economies of the world use this means, the debt, and as I said, the word is bond, to raise money from the market. So this is what we are discussing today, that the Government of India bonds are going to be traded abroad. But let's just again step back a minute. As we said, India faced a huge balance of payments crisis in the year 1991. Remember when we had to pawn our gold to pay for the money that we owe to the rest of the world? It left a very bad mark on the Indian economy, a big scar on the policymakers. India became very, conservative, and for the right reasons. The India government and successive political parties have run on the same principle. And what's the principle? That first of all, don't raise money, don't borrow from the markets aggressively, so have a conservative fiscal deficit. Second, and that's a very important part, if you are going to raise the money, raise it from the domestic market. This has been an important article of faith in India. When we say domestic market, what does it mean? You must have heard about, and many of us do invest in public provident fund, the post office savings bank. Where does that money go? Well, that money goes to the government of India. The government of India offers such avenues to the retail investors. There used to be the RBI bonds, which did the same work, and for the banks and for the insurance companies, the domestic banks and insurance companies, from there government borrows money to finance its program. Why does the government need to borrow? Because obviously the taxes that the government raises are much lower than what the government needs to run all the programs that it wants to do. So it borrows from the market. And as I said, India has kept a very sharp eye on the extent of what is called the short-term debt. It doesn't raise too much money from the market as short-term debt, essentially, borrowing of say less than 1 year. The borrowings are longer, and again, these borrowings are all in domestic market. In fact, the extent of foreign borrowing that the government of India does is one of the lowest in the world, and among its peer group, it is not only the lowest among any major economy, and India is today the 5th largest economy of the world. It is by far very low. When you raise debt in domestic currency, what happens? You essentially say that for each 100 rupee that I'm going to raise from you, what am I going to do? Or let's put it this way, supposing I am the government, I am raising a loan of 100 rupee from you. Obviously, I'll have to pay you an interest. But if I do it within the country, then the advantage is that that interest will be paid for in rupees. So the debt is raised in rupees, the repayment is also done in rupees. But as we say, there was a necessity of foreign exchange. And remember the resurgent India bonds or the India Millennium bonds, what happened there? There the government said that I will raise the loan in a foreign market and pay the interest in dollars. It was, officially it was raised, the loan was floated by State Bank of India, but it was a government of India backed security. But the government of India had to pay a high rate of interest, because within the country, while you could pay a low rate of interest, abroad, India with its low credit rating in those times, even now it's not really very high, but at that time it was below investment grade, India had to pay a very high rate of interest. Now hold that thought, we'll come back to it. The government of India has been extremely cautious about raising money from abroad. So what did it do? Well, if you don't want to raise money from abroad, that's fine. But then what happens is you end up short on foreign exchange. And for lots of purposes, for instance, if you're planning to buy an aircraft, you're planning to buy a defense equipment, many of those are not available within India. So where would the government get the money from? It can't sell in rupee, it can't buy those items in rupees. It has to therefore buy those in foreign exchange. Now what are the ways? What are the ways in which a country earns foreign exchange? There are 5 ways. A, there can be foreign investors who can come and buy shares in an Indian company. They will buy it in dollars. So the dollars will be taken over by Reserve Bank and added to its reserves. That's one way. Second is by investing in government debt, and we are just talking about it. The third is remittances. When Indians who are working abroad send their salary income to India, they send in different currencies, dirham, dinar, dollar. So that's the third thing. Fourth is tourism. When foreigners come to the country, they spend in their respective currencies, the country gets the foreign exchange. And the fifth is the excess of exports minus imports. Now, as you can see, we get some money through foreign exchange, through the foreign portfolio investors investing in Indian shares in the Indian market. It's been rising, but we don't get much from the government bonds. We get the world's highest remittances. The Indian remittances, according to the World Bank estimate, has now crossed about $100 billion. So that's a very big thing which comes from all the diaspora abroad. The tourism revenue, however, is very small, and we get only a little bit. And we, across the world, most of the time, we are importing much more than we are exporting. Oil, for instance, and we import oil, and our exports are still, they are gaining traction, but we still run what is called a current account deficit. So overall, India's ability to get foreign exchange from abroad is limited, except as we said, the foreign portfolio investors who invest in Indian shares. Now, the interesting thing that's happened, and this is the most biggest change that has happened in India in the last 30 years. From a position where India was at a point where it was actually going to renege on its obligations abroad, today the Indian economy, the past 30 years and in the past few years, it has done so much better that today investors from abroad want to invest in Government of India papers. But as we said, the Government of India does not allow its papers to be sold abroad. So has that changed? So to come back to that story again, as the economy expands, the demand for forex rises. We all today do so many of our transactions in forex. So obviously that forex has to come. The government does lots of investment. The government needs the money in forex. That forex has to come. So where will that forex come? Now this question was debated in 2018 in the Government of India budget, and a plan was mooted that the government will float a bond abroad. It's different from this, and I'll tell you why. But the plan was made to raise a Government of India bond. There was one problem. What was the problem? India's rating with Standard & Poor's or with Moody's is just investment grade, which means that if India had floated, say, an equivalent of a Resurgent India or a Millennium India Depot fund, it would get a better return, but still not too much. It will still have to pay a higher rate of interest. So that plan was jettisoned. Instead, what the government looked at was the possibility of getting included in a global bond indices.
Moving on to an important story then, bond market sentiment has been boosted by speculation over India's inclusion in global bond indices.
Now this is interesting. When the global bond indices came knocking at India, or rather India started discussing the issues with them, there are two things that they wanted. One was that since India was just investment grade, one of the first things that they wanted was that there should be a tax benefit for the foreign investors. The second thing was that the bond, the buying and the selling of the bond should be in European market, where there are dedicated clearing corporations. So essentially the idea was that if a foreign investor comes, she would want a very liquid market. The Indian clearing markets, the Indian debt market is thin, which is a valid point. It can't give that sort of liquidity. In other words, that if you buy an Indian paper, If you want to sell an Indian paper, you can't sell it very fast. But if you can sell it in Europe, in the European market, that's easier. Well, anyway, that was where the discussion was. And why did Government of India think getting into the bonds market, or rather the bond indices, is a good thing? So we'll have to look at what these bond indices are. The JP Morgan indices or the FTSE Russell. What is it essentially? It says these are the market managers, the fund managers. What do? They say that we will pick up a bunch of bonds of, depending on which sort of sectors it is, in this case emerging markets, into and create a portfolio. Fine. And in that portfolio, what then does happen? The investors, and these investors will be pension funds, insurance companies, or just about anybody with a good sum of money can invest in these indices. What's the advantage for them? The investors don't need to understand how the India government functions, or how, say, the Indonesian government functions or the Egyptian government functions. Instead, what happens is they simply put up their money, and it is the job of the portfolio managers, in this case JP Morgan, to decide how much in each $1,000 of investment, how much should be the Indian money that should be invested in. So the responsibility is theirs, and what do is they do the market research on behalf of the investors. They assure the investors that we will give you X% return. So the investors are happy, they don't have to think about it, they get very easy liquidity, that whenever they want to sell, they can sell these papers. And to ensure that this happens, the bond managers, in this case again as I said, either FTSE or JP Morgan, what they do is they do huge amount of due diligence exercise. They look at the country profiles, the company profiles, and only then allow those papers to be part of their portfolio. So to be included in those portfolios is a very obviously is a prestigious game, and only those countries or those corporations which are good make the cut. Now India had done it in a very strategic way. What had India done? It had said, yes, we want to get included in it, but we also realize that we have got problems in the sense that we are an emerging economy, we have got a fiscal deficit concerns, we have got concerns for the lower income people, so on and so forth. So one of the things is we cannot offer a specialized tax treatment for the foreigners to compensate for our weaknesses. You want to buy our bonds, take it or leave it. This was not acceptable. This was not acceptable to the fund managers. And as I said, I had written about this earlier several times, this is where the matters had stalled. But now what has changed? Well, what has changed is that first of all, in a neighborhood, China's star has started waning. There are in fact, there are just no emerging markets where the stars are gleaming other than India. Russia has gone out of these indices. So the bond managers were left with no choice but to accept the Indian demand, and it was a very reasonable demand by India that we can't offer a differential tax treatment. It would have created enough problems in India, or we would not be wanting to get into the Euro market. You give us the option that it should also be traded in the Indian market. And remember, this is the Government of India bonds. These are not the bonds by companies. If the companies want to get into those indices, and they do, that's a different game altogether. This is the India government bonds. So India government was very clear that this is how it will be done, and today's announcement is a ratification of that consistent commitment, or the consistent communication from the Government of India, that this is how we will come into the global bond indices. And as I said right at the beginning, coming into the indices immediately means that those passive investors sitting on whose money these bonds, these fund managers are managing, will be putting into the Indian market, and the upside is at least about $20 to $25 billion in addition to what India gets. It's a very big upside. So as we said, the government can afford to feel nice today, and as the finance ministry release shows, they are feeling nice today. But there's a but to it. One very important outcome of this effect or this inclusion is that those investors, just as they are very comfortable coming into the bonds, they will also be very comfortable going out of the bonds if the government doesn't stick to its part of the bargain. And what is this bargain? First of all, the fiscal deficit. Every time now the finance minister gets up to announce a particular number of the fiscal deficit, that number will have to be thought through very carefully. Otherwise, countries can be hammered very badly. Countries have been hammered. In fact, just along with today's announcement that India is making the cut, there is a warning that Egypt might be taken out of the bond indices, because Egypt has not been maintaining its government finances well. So this is the impact, which not just now of 1.4 billion Indians on government finances, but of a larger number, 7 billion. Well, okay, not 7 billion. That's the entire world doesn't invest in these, but still a considerable number of people from abroad will be looking at Government of India finances very carefully. So the Government of India therefore now will have to be very responsible in terms of making commitments of expenditure, in terms of making commitments on income. And that, I think, is a very wonderful thing, because in public finance, this is something that we have been saying very long, that governments should be subject to tight discipline. If you make a plan to spend, but spend it well. Don't suddenly announce schemes. Don't suddenly say that this money will be spent here, or suddenly don't give tax reliefs when you can't do it. Yes, the price is going to be very heavy. Just as today there will be a huge flow of capital into India, those announcements, any one of those announcements can lead to a huge flow of capital out of India. So it's a double-edged sword. What about the economy? Well, that is very good, because what happens is that as a huge amount of foreign exchange comes into India, and we are talking about a $125 billion worth of infrastructure investment that is needed to be done in India, an additional $20 billion every year coming in from 2024 to 2025, and then it can go up further as other indices come in, is a huge money. If the Government of India had to actually raise taxes to be able to finance those expenditure, it would have been ruinous. And we know how much of infrastructure deficit we have in this country. So here is the infrastructure deficit, here is the investment possibility, and the government has played its cards well. So this money is extremely welcome and is going to come. What about you and me? Infrastructure we have talked about, but there is another very, very major advantage. As an economy comes in the international glare, it has to behave very responsibly, not just economically, but also on social parameters, on very large parameters of issues that concern all of us Indians, issues like equity, issues like inclusiveness. Investors today don't like to be investing in countries where there are question marks about that country's ability to move, to bring in larger number of people into the national mainstream. So there is a lot upside there. And this is therefore on a highly optimistic note that we will close this edition of On Point.